There are 600,000 more sellers on the United States housing market right now than there are buyers. 600,000. That gap has not been this wide since 2008. And yet the majority of sellers still believe they are going to get their asking price. That is the central contradiction in this market right now. And today we are going to walk through 5 specific shifts that are actively reshaping the housing landscape in 2026. Whether you are a renter, a buyer, or a seller trying to figure out your next move. My name is David Cole. I am the editor-in-chief of Housing Intel. This channel exists because the real estate industry has a financial interest in telling you things are fine. We do not. Subscribe now and join the people who are making decisions based on data, not on spin. Hit that subscribe button. Now let us get into what the numbers actually show. The first shift is that sellers are stuck, and the ones who cannot sell are becoming landlords by default. According to current market data, only approximately 25% of Americans today can qualify to buy the median-priced home in the United States. That number defines the ceiling on buyer demand more precisely than any other single figure in the market. When 3 out of 4 households cannot qualify for the purchase, you do not have a pricing problem, you have a structural demand problem, and that structural problem is locking a significant share of sellers out of the transaction entirely. It also means that every price reduction a seller makes is not automatically unlocking new buyers. The qualifying pool problem is not a function of price alone. It is a function of the relationship between prices, current mortgage rates, and household income levels. All 3 of those variables are working against sellers simultaneously. What happens to a seller who cannot sell? The data shows that approximately 2.1% of recent sellers have converted their properties to rentals rather than accept the market price. This is concentrated in Tampa, Houston, Denver, and Miami, but it is happening in markets across the country. These sellers are not investors. They are homeowners who bought before prices and rates moved to current levels, who can generate $400 to $1,000 per month in cash flow from a rental, and who have decided that waiting is more rational than selling at a loss. They are accidental landlords, and their decision is creating a downstream effect that extends well beyond their individual transaction. The rental units they are adding to the market are competing directly with existing rental inventory, applying downward pressure on rents, which in turn weakens the economic argument for buying at current prices. Inventory is back to pre-pandemic levels in most major markets. Sellers are competing not just against each other, but against home builders who have been cutting prices and subsidizing mortgage rates aggressively. The combination of a qualifying pool problem, elevated inventory, and builder competition has produced a market where the seller who prices correctly from day one is closing deals, and the seller who prices to their expectation is sitting. And the gap between those 2 outcomes is not narrowing. The second shift is that rental supply is surging, and that surge is putting direct downward pressure on the for-sale market. The accidental landlord effect is one input into the rental supply increase, but it is not the largest one. The larger inputs are new apartment deliveries, rising vacancy rates as households combine to manage costs, and the simple economic reality that when buying costs significantly more than renting, households stay renters longer. All 3 of those forces are operating simultaneously right now. The pipeline of new apartment units that broke ground during the 2020 and 2021 construction surge is still delivering into the rental market. That supply does not care about the state of buyer demand. It arrives on schedule regardless of the macro environment, and it is arriving into a market where absorption rates have slowed. Rent growth nationally is running at 2.6% year over year. That is the smallest annual increase in over a decade. Several major markets are already posting outright rent declines, and the relevance of this for the for-sale market is direct. For-sale listings compete with rental listings for the same household. When the monthly cost of renting falls relative to the monthly cost of owning, the argument for buying weakens. The spread between the cost of ownership and the cost of renting in most major markets is still historically wide, and the widening of that spread is not an argument that helps sellers. It is an argument that benefits renters who are content to wait. Every basis point that rents fall makes the ownership math harder to justify. Sellers need to account for that dynamic when pricing, because their buyer pool is making that calculation in real time. Before we get to the next point, I want to hear from you directly. Drop a comment below. Are you currently renting and watching the for sale market? Are you a seller trying to navigate this environment? Or are you a buyer waiting for conditions to shift further in your favor? Tell us where you stand. Your situation shapes what we cover next. Now back to the data. The third shift is that renters have more leverage than they have had in years, and that leverage is directionally shaping the broader market. This is the shift that sellers are most likely to underestimate. Renters are not a passive group waiting to become buyers. They are active participants, making rational economic decisions about where to live and what to pay. When rental supply expands and rental prices fall, the threshold question for a renter considering a purchase changes. The comparison is no longer just price. It is price relative to the cost of the alternative. And the alternative is getting more affordable at the same time that ownership costs are staying elevated. The implication for sellers is concrete. Your buyer pool is, in large part, composed of current renters who are evaluating whether ownership makes financial sense at your asking price. They are running that calculation against what they are currently paying in rent, and in most markets, that calculation is not resolving in your favor. Sellers who price their home based on what they personally paid or based on what they paid per month with a mortgage originated several years ago at a much lower rate are making a fundamental analytical error. The relevant comparison is not your carrying cost. It is your buyer's carrying cost if they purchase your home today at today's rates. The fourth shift is mortgage delinquencies are rising at a pace that has not been seen since 2022, and the direction of that trend matters more than the current absolute level. According to current data, there are approximately 878,000 mortgages that are 90 or more days past due or already in active foreclosure. That figure is up 25% in the past 4 months alone. VantageScore data shows serious delinquencies rising 18% year over year. The primary drivers are elevated mortgage rates, rising insurance costs, and broad household budget pressure from higher costs across every major expense category. It is worth noting that mortgage delinquencies are not rising in isolation. Auto loan delinquencies are up. Credit card delinquencies are up. Student loan delinquencies are up. This is not a housing-specific stress pattern. It is a broad household balance sheet deterioration playing out simultaneously across multiple debt categories, and the housing market is not immune to the downstream effects of that. The borrowers most exposed are FHA borrowers, which are buyers who purchased with lower down payments and entered with limited equity cushion. In markets where prices have declined since purchase, a significant number of these borrowers are underwater or have effectively zero equity. The data shows that borrowers who fall behind are not recovering quickly. They are transitioning into deeper delinquency stages rather than catching up. Google search data for mortgage help has recently spiked to the highest recorded level, surpassing even the period before the 2008 crash. That leading indicator reflects the population of homeowners who are not yet in default but are beginning to calculate whether they can maintain their payment. To be precise, current delinquency levels are not near 2008 scale. That period produced 10 million foreclosures. The current environment is not that, but the rate of increase and the directional trend are the data points that matter for projecting where this goes over the next 6 to 12 months. The fifth shift is the condo market has crossed from expensive to structurally impaired for a large share of buyers. Condominiums were historically the entry-level path into home ownership for buyers who could not afford single-family homes. That function has broken down. The reasons are layered, and each one compounds the others. HOA fees have increased dramatically across the country, particularly in Florida, where post-Surfside legislation has forced structural reserve funding that associations had previously waived or deferred. Special assessments in affected buildings have reached 6 figures per unit in documented cases. Monthly carrying costs on condos that once looked affordable have crossed thresholds that make them functionally inaccessible to entry-level buyers. The financing environment has made the situation worse. Many condo buildings are on Fannie Mae's restricted list due to reserve deficiencies, deferred maintenance, or structural compliance issues. That designation eliminates conventional financing for units in those buildings, which means cash buyers only and a dramatically compressed buyer pool. FHA financing for condos is technically available but limited to a small list of approved buildings. The practical effect is that a buyer evaluating a condo in most urban markets today faces either a 25 to 30% down payment requirement, or they are in a building with known structural or financial problems. New condo construction is almost exclusively aimed at luxury buyers. The entry-level condo as an asset class is disappearing in high-cost markets, replaced by units that carry price tags and monthly costs that put them out of reach for the households that historically needed them most. So let us bring these 5 shifts together into a coherent picture of where this market actually stands. The seller's surplus is real, and it is large. 600,000 more sellers than buyers is not a market that self-corrects through patience. It corrects through price. Rental supply is expanding, and rental prices are falling, which weakens the economic argument for buying at current prices and extends the timeline for demand recovery. Renters have leverage, and they are using it, which means the buyer pool is rational and price-sensitive in a way that it was not 2 and 3 years ago. Delinquencies are rising fast from a low base, and the leading indicators suggest the trend has not peaked, and the condo market has moved from overpriced to structurally impaired for a large share of potential buyers. If you are a seller and your home has been on the market for 60 days or more without meaningful activity, the data is giving you a clear signal. Every week that passes, comparable sales in your area are establishing lower reference points for appraisers and buyers. The sellers who are transacting right now are the ones who priced to where the market is, not where it was. That is the only playbook that is working in this environment. If you are a renter, the data is moving in your direction. More supply, lower prices, more negotiating leverage. The case for rushing into ownership at current prices is not supported by the numbers. The fundamentals of affordability are still working against buyers at current price and rate levels in most markets. If you are watching delinquency trends and trying to understand where the foreclosure supply is headed, the directional evidence suggests continued increases over the next 2 to 3 quarters. That supply, when it moves, will add to existing inventory pressure in markets that are already supply-heavy. The housing market in 2026 is not a market in recovery. It is a market in adjustment. And the adjustments that still need to happen are visible in the data for anyone who is looking at the full picture. Sellers who understand that are making transactions. Sellers who are waiting for the market to validate their original price are watching their window get smaller every week. The data is not ambiguous on this point. The direction is clear, the signals are consistent, and the sellers who act on that reality now are the ones who will have more control over the outcome than the sellers who wait. And that is exactly why Housing Intel exists. We are here to give you the data, the analysis, and the honest picture that the real estate industry will never show you. If you found this video valuable, subscribe to Housing Intel right now and hit the notification bell so you never miss a report. The market moves fast. The people who stay informed are the ones who stay protected. We will see you in the next one.